Hey guys, this video is a compilation of the 3 morning video series 1 made this week all in one. I have decided to make it a single video to make it all more available for you guys. I got a very positive reaction to this series and decided to fit all 3 in one with some minor editing. I hope new people find this education and insightful. I want to thank Amanda Fisher, whose work and due diligence has inspired me to make this video. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. In America, over 700,000 people have died because of the virus. Efforts to keep sick patients breathing are draining resources in Florida, and some hospitals are finding themselves competing with municipal water systems for crucial supplies of liquid oxygen. Cities have begun to ask people to help conserve water by cutting back on non-essentials like washing cars or watering lawns or pressure washing. Eviction notices grew considerably in Arizona and Texas. It is estimated that 1/3 of New York's small businesses may be gone due to all the problems that have risen because of the virus. People are going out, but not all businesses aren't fully packed as they used to before 2020. As you can see, you do not have to look far to see how unstable the economy has become in a little over a year. Take any demographic or any societal performance statistic and you will find some pretty drastic changes. As the crisis continues to unfold and reality slowly sets in that our recovery isn't going to be a quick bounce back, there is one slice of our economy that not only has outperformed every other, but has thrived so much they have continuously broken most major historical records and benchmarks. The insulation of Wall Street institutions has allowed certain companies to directly benefit off of the drastic changes that have constrained, halted, or killed so many of us. The S&P 500 is up 17% year to date. Companies like Apple doubled in market capitalization. We saw bond issuances by companies reach all-time highs at the same time. So, how is it that there is this weird gap between the fates of people and small business in contrast to Wall Street, which is making an absolute killing? The abundance of money and success performance has most certainly not been felt outside of the few that were already on top. The answers to this become incredibly evident once we examine policy making from 2 different alternating angles. One will look at the direct policy changes done during the pandemic recession, while the other is more directed at looking through decades of policy changes that allowed for Wall Street to be engorged with profits once the economy hit this particular shock. For sake of keeping this video easy to understand without compromising any of the depth needed to make some points, I am going to over all different parts of the problem in this video. Tomorrow we will talk about how Wall Street's insulation of preferred companies allowed to further grow their footprint, as they engaged in hostile tactics that destroyed a ton of competition. Friday we will talk about how policy is directed to prevent the economic boom at Wall Street from trickling down. Let's begin at the cornerstone of the current problem, which are individuals, families and small businesses. All 3 are currently on the edge of a cracking economy that is about to default in less than 2 weeks. Inflation keeps growing to the point where minimum wage workers can no longer even afford to rent places in a big city. Food insecurity is growing, especially in households with children. Small businesses seem to be closing down left and right. Public health data suggests people experiencing depression, anxiety, substance abuse, and even suicidal ideation have grown substantially. This has led to people dating less, which has impacted birth rates and the economy as of itself since dating is a major driver in money spending. Research provided by Columbia University shows that policymakers do indeed have the tools and ability to greatly counteract many of the symptoms. I will get to the great policy to cure the problem on Friday. Just keep in mind we are introducing everything today. Financial aid that was distributed greatly benefited society. Harvard University produced research directly demonstrating that the direct payments done as stimulus checks helped households in the poorest zip codes maintain necessary spending. The quick actions that took place last year as a resort to prevent a full economic crash worked. However, as many of these policies have been lifted, it has now brought a myriad of problems to workers and families, and in particular small businesses. They are ultimately being unable to survive in a world where so much has changed in so little time, and many are quickly finding themselves in the streets and closing shop. We have been talking a lot about housing during the past month, and this reality is the same for it. Housing stability is becoming more unstable for average and poor families. All in all, Data shows that policy is and can be a great tool to protect both individuals and small businesses, affording them the much-needed support to brace the recession brought about by the pandemic. Many of the policies implemented have literally saved America. However, many of these policies are being lifted, and many are unprepared to deal with the hardships of the world, as some of the problems cannot be fixed by the government overnight. A small business might find itself in trouble being unable to attract enough foot traffic at its location. Competing against corporations on the e-commerce will be incredibly hard, since e-commerce giants like Amazon will ensure that the prices for their products are lower than competition in order to drive in most of the sales and eventually have their competition go bankrupt. With many of the policies being lifted, inflation and housing prices are having people evicted and being unable to afford things like food, rent, or debt. We are simply not at a point where we can really afford to let the middle and lower class go unprotected, because doing so will certainly crash the economy in the end. Now that we addressed the cornerstone, the next part is talking about the incongruencies in the problem. This is where we get to Wall Street, the New York Stock Exchange, NASDAQ, and the bond market. Let's quickly recap some key concepts we covered just so that we are all caught up to speed. We talked about how individuals, families, and small businesses were impacted by policy from the government. Citing some studies performed by academics, we have data that supports the claim that many of the policies the government implemented did help all three groups survive through the pandemic, while also allowing for the economy to not crash. However, as many of the restrictions have been lifted, and people are slowly reintegrating back to normalcy, things are still not as they used to be. We have seen many people respond in different ways. Many are avoiding going out due to health concerns, while others have elected to simply stick to the changes they have had to make. Simply put, many are simply not financially adequate to keep up with so much change, given that many of the financial provisions have been lifted off. With other problems like inflation driving the prices of rent and consumer products up by the month, individuals, families, and small businesses are finding themselves having to make tough choices on what they have to cut to survive. Every part of the economy has been severely affected, except for Wall Street, which has been insulated from all of these problems. Now we finally get to the part where we talk about why it is that Wall Street and its many institutions are having all-time highs, enjoying tremendous success that makes no sense in direct contrast with the rest of the economy. We are going to talk about the stock market and the bond market in particular. As you know, stock prices are determined by the confidence of investors in the potential future earnings of a given company. Though not extremely risky, there is still a chance for stockholders to experience loss if a company they are invested starts to miss projections or experiences some type of failure. In good times, stockholders get compensated through dividends or simply the profit of watching their assets grow over time. One would imagine that with the pandemic ravaging the globe, forcing many businesses to close down and everyone to stay home for months, that the stock markets must have taken a huge hit, and that they should be now slowly moving back up. Well, that has not been the case. In fact, quite the opposite happened. The S&P 500 is performing extremely well, with its 5 top companies pretty much leading the rest upwards. Apple, Amazon, Alphabet, Microsoft, and Facebook represent around 1/5 of the total market capitalization of the 500 largest firms in the United States equity market. To put things in perspective, all the 500 companies in the S&P 500 represent over 75% of all the value of all equities traded on the stock exchanges. This concentration of the top companies all being in the technology sector has been what allowed them to dominate the stock market in general. We are at a point where the top companies I talked about all outpace entire indexes in gains. Now, the reason why I mentioned all of this is because, as we initially said, stock prices reflect an investor's confidence that the future health of the company will be better than it currently is. With this in mind, it makes sense why technology firms have inspired so much confidence during the pandemic. With people initially quarantined and now preferring to work from home, it makes total sense why investors feel confident in investing in tech sectors that are uniquely suited to benefit from the transition that has taken place. It is not even just work for the individual and families. People are changing the way they shop, with surveys showing 60% growth as of last year in grocery purchases, 45% growth in online over-the-counter medicine, and 18% in online consumer electronics purchases. There is a reason why Amazon has had the absolute monster run since 2020. The company reported a 40% growth in earnings on its second quarter of 2020. The growth has made the company decide to convert vacant mall department stores into distribution centers, as many of the company's rivals going out of business since they are unable to compete against the behemoth that is Amazon. Now that I have established some of the facts, let's start diving into why it is exactly that so few companies are able to survive when it seems that everyone else is unable to get enough online traffic. Diving into the core reason takes us back to the government and how its competition policy favors big tech. The Washington Center for Equitable Growth's Director of Competition Policy Michael Cades has noted that weak antitrust laws and courts tend to use unsound economic theories that continuously expose markets to corporate abuses of power, which boosts large corporations' profits and dominance at the very expense of their competitors, workers and consumers. Many practices are placed that allow dominant companies to stifle rivals, even potential ones, which prevents healthy competition on merit and allows incumbents to obtain and exploit market power. Cades made several examples, citing instances where practices were placed that ensured big tech abused their position to eliminate competition. He pointed to when Facebook cut off community entertainment Vine's access to Facebook because they viewed them as a dangerous competitor. He talked about how Amazon's prices proprietary products and services below costs to drive out competitors so they can then monopolize a certain market and then raise prices way above what they should be. He talked about how Apple discriminates against apps that compete with their products, and how Google forces customers into their own content and products over their competitors. In the end, Cades noted that new legislation is needed to enforce agencies' and courts' abilities to bring back balance to antitrust laws. One of the things I have personally seen that also affects consumers is giants buying out all competition. Through the years, we have seen how companies like Disney have devoured pretty much everything that stood in their way. They have been allowed to buy out Marvel, Pixar, Fox, Hulu, ESPN and many others. Microsoft is famous for being another company that loves to buy any up-and-coming start-up or company with relative success. This only hurts the economy because it continues to foster all the power among a very few Wall Street-favored corporations that only know how to devour or destroy others for their own benefit. The policy we have not only allows these things to happen, but actually perpetuate it. There is enough evidence to suggest policymakers actually suppress competition through harmful exclusionary conduct. How can we be a capitalistic society when nobody is allowed to succeed at starting a business and growing it too big without big tech either taking you out by copying your product or service or outright buying you out? Wall Street has made tons of money by funding themselves with shares for these companies, because it affords them huge earnings and the guaranteed return on investment since they have helped these companies take control of policymakers. By helping big tech rid themselves off of competition, they can guarantee most investments to be on their preferred stocks. We recently talked about how ETFs have been surging while the amount of companies in the stock exchange have dropped significantly. There simply is no benefit in going public, especially when Wall Street has found ways to cheat the system to their favor. Moving to the bond market, firms have now found enriching ways by which they can fund themselves with bonds, which for those that don't know are securities issued by a firm paying a pre-established rate of return for a fixed period of time. When you look at some of the figures laid out, you will see that the bond market has become extremely robust, and Wall Street has been the biggest beneficiary of all. Unlike the stock market, the bond market has performed extremely well for all types of companies, not just the ones on top. Trillions of dollars were issued last year and trillions have been issued this year at record numbers. Companies have needed to raise additional money to help feed them while they survive the decrease in revenue brought by the pandemic. Many other companies, without the need for such type of measure, have decided anyways to issue new debt because of the historically low cost of financing. Heck, even Alphabet and Apple borrowed billions of dollars to get in on the opportunity to borrow some debt financing. And it's not just the investment-grade bonds getting high records. Riskier firms have been issuing bonds as well. You might be wondering, but wait, how does any of this make sense? How come they are allowed to borrow so much money while big tech is having major indexes at record highs on the stock markets? Well, the culprit of it all falls back on the Federal Reserve. This is where we get to meet the one and only Jerome Powell and his infinite lack of wisdom. The bond market seized up back in March of last year, but the Federal Reserve made an announcement that it would undertake a number of aggressive measures to boost the economy, including buying bonds and ETFs backed by bonds using funds appropriated under the CARES Act. This very announcement produced a huge grin on every Wall Street executive. It caused markets to rebound and do a full 180, bringing back more confidence in the markets than there was before the pandemic. Jerome Powell noted that the central bank would not run out of ammunition, which in other words means he would be printing money non-stop for Wall Street to not only survive, but make an absolute record killing. As you might imagine, the parties held that night on Wall Street after such a statement must have been absolutely legendary. Little did they know that Jerome Powell is the type of guy to not really think ahead and remember that unlimited printing has very bad consequences for an economy, and that it can literally cause an even market crash that the pandemic could have ever brought. Why do you think the man is changing his stance on a day-to-day in regards to inflation, one of the outcomes of unlimited printing? He doesn't want to shoulder any responsibility for causing this chaos affecting everyone. Among all the individual bond purchases, the Fed has been particularly concentrating on blue-chip companies, which for those that don't know are the well-established corporations with household names. The Fed also helped out riskier companies through their insane number of purchases of ETFs. The reality is that the Fed got in too deep on this, owning over $12 billion as of last year. The effects are extremely profound and show that they are willing to do whatever it is to stabilize corporate credit makers and keep the market afloat. By doing this, Wall Street executives have been cannibalizing a ton of funds and making an absolute killing on their end. They have the Fed essentially working for them, and the Fed has an unlimited printing machine which they are more than happy to keep working for Wall Street. It is absolutely ridiculous that the government let this happen, and it sucks even more that the problem is so out of hand that they cannot stop printing, because if they suddenly did, they could unleash a huge disaster. Again, the only reason why Wall Street and the markets are afloat is because of the confidence brought by the Fed and their unlimited printing machine. It is single-handedly the only reason why we have not gone under yet. If you take this away, a lot of that confidence will disappear into thin air in an instant. I have absolutely no doubt the decisive decision by the Fed saved the economy, but it has gone too far, and with the poor regulatory oversight by the government, this has turned out to be a much worse problem than the pandemic ever was. By trying to save ourselves from the virus and the chaos it brought, the Fed and the government have started something they don't know how to properly address. Let's quickly recap some things. We discussed the ways by which individuals, families and small business were affected by the pandemic and the policies that were implemented to rescue an economy on the verge of disaster. Then we talked about why it is that Wall Street has benefited so much by the pandemic. We looked at the stock and bond market, and discussed how policymakers made it impossible for competition to arise, making the wealth be fully concentrated among a very small number of corporations and Wall Street. We went over how the bond market in particular is using the Fed to infinitely print the money, isolating the gains from abusive practices that should have never been placed without oversight. Now we will talk about why and how none of the profits made by Wall Street trickled down to the rest of the economy. With precision, I will point out the greatest flaws in the system that prevented anyone from being able to enjoy much of the benefits that were supposed to be given back to them through the taxes they paid. So, we know that the stock market and the bond market made an absolute killing. The question then follows, how are individuals, families or small businesses benefiting from stocks and bonds? Are stocks preventing layoffs or boosting individuals' investment incomes? Are they bringing in customers to small businesses, or helping state and local governments with declining revenues? Let's address each of these questions directly. Financial market gains are not preventing layoffs. Only 17% of workers are employed at an S&P 500 corporation, which pales in comparison to small businesses, who employ nearly half of all the workforce. Most businesses don't issue stock either. You would think that companies that issue shares and see positive growth would feel confident innovating or investing in workers, but that is simply not the reality. In fact, investors penalize companies for investing in workers. American Airlines was downgraded by analysts for giving its pilots and flight attendants raises. The famous Chipotle Mexican Grill experienced a stock decline once analysts determined they could not reduce its workforce costs. Big tech companies don't employ that many people in comparison to their share of stock market's total value. While the small number of firms represent 1/4 of the market capitalization, they only represent 5% of the workforce in the S&P 500. They are also more likely to use gig workers and independent contractors, who do not enjoy job security. Uber and Amazon use independent contractors because it is a cheaper alternative than employing people. Google and Facebook use them too to screen their platforms for inappropriate content. The unique position that was brought about by the pandemic caused a huge surge in the tech sector, but much of its growth has to also be attributed to the outgrowth of antitrust policies that allowed prolific mergers and acquisitions like the ones we talked about yesterday. Let's talk about the Fed. I must ask that you guys try to digest what I am about to say in the most fashionable possible way you can. Learning some of this stuff is really going to frustrate many of you. The Fed's bond support could have hypothetically supported workers at any companies that had issues with debt. Boosting companies on the verge of bankruptcy or default on payments was way better than having to deal with a company that had already gone bankrupt and laid off all its workers. Through the CARES Act, discretionary authority for the Fed to rescue companies in order to retain jobs, maintain agreements, prohibit dividend and stock buybacks and limit executive compensation. This made total sense, but the Fed started looking, manufacturing and using legal loopholes to sidestep these conditions imposed by the CARES Act. A great example of this is when ExxonMobil issued a ton of bonds, which the Fed purchased. While ExxonMobil did this, they were also preparing to start cutting jobs and ending their employer match for their remaining employees' 401k retirement plans. There are tons of stories of companies being allowed to issue bonds, which the Fed used, and then they were allowed to fire millions of workers anyways, which meant that all the money that they raised from issuing those bonds still went back to the executives and to buy back their own stock, which is why many of these companies had great stock market performances right after the pandemic. They literally got the Feds to print the money they used to buy their own shares and pump their stock. As for the workers and families that were left stranded, nobody really cared as the main media was too focused talking about how great the economy was since the stock market has been doing so well. The next point I brought up was regarding the potential boost to investment incomes. Well, to the surprise of no one, things do not fare better here. Though half of Americans are invested in some stock, either directly through a retirement plan or not, most of the value of all stocks are heavily concentrated. In fact, the top 1% of households own more than half the value of all outstanding shares. Corporate bonds for individuals are very limited in the United States, which makes it very unlikely for Americans to experience any substantial income from investing in bonds too. Going back to stocks, I had made a video talking about how one of the ways by which the rich get richer is by continuously rising the prices for everything, making it less accessible for others to attain. As such, good stock investment income becomes harder for middle and lower class to attain. They literally rigged the game for themselves so that nobody can have access to the pool of wealth. The next point into figuring out if profits from Wall Street are trickling down is to see if small businesses have seen growth in revenue or traffic. Well, the Fed's action is doing little to nothing for small businesses. Small businesses don't issue stocks or bonds, so much of the intervention the Fed could potentially do goes right out of the window right there. Low rates should theoretically allow small firms to borrow cheaply from banks, but bank lending is retrenching as financial institutions continue to become more risk-averse during the pandemic. The Fed had initially created a separate program to facilitate direct lending to small to medium-sized businesses, a program known as Main Street Lending Facility. However, despite the $600 billion available for funding, the Fed only committed to $252 million across a little over 30 loans in total. As you can see, the Fed's sluggish program was made with the intention of not really helping any small businesses, because what better way to take out Wall Street's competition than leveraging the pandemic restrictions and use it against business owners? The Fed is an absolutely disgusting institution that not only should be held accountable for the way they have operated, but should also be broken apart and put out of its misery. No, I do understand that the Fed has a vital role in our economy, and for that I think we should replace it with a newer institution that works in a more appropriate manner, and one that can be more easily held accountable. Jerome Powell is an absolute genius in much of what he manufactured these last 2 years, and he is the scum of the earth for doing so. The recession and policy response produced an inadequate response from the Fed that ultimately allowed for the crippling of most small businesses. Many have gone bankrupt, and many are on the way to close shop forever, all because Wall Street must be favored above all else. Last point was whether local and state governments were helped with their declining revenues. There has been a very apparent lack of emergency support for state and local governments bearing the increased costs of fighting the pandemic. Public sector job losses and services were cut for a long while, which handicapped the economic rebound that should have happened. This was once again brought by the Fed and some of the impositions that they forced. Their requirements were so much more stringent on municipal borrowers than the corporate ones. Data shows that by mid-August of last year alone, over 6% of the workforce in states and localities were cut. The answer is a huge resounding no for this one too. The idea that trickle-down economics work is just that, an idea that has been allowed to propagate for too long. The success of Wall Street because of the pandemic did not trickle down to individuals or families, nor did it trickle down to small businesses. The CARES Act allowed the Fed to use their own discretion in enforcing balance, and the Fed made sure to use all its power to make sure that only the rich and Wall Street saw green balance sheets. Congress failed to provide the needed support, and now we have an eviction crisis, a health crisis, an addiction crisis, child abuse, and a huge list of other problems that we must as a society pay the cost. Meanwhile, Wall Street has continued to stabilize their profits and are setting high benchmarks for years to come. They continue to recover faster than ever imagined, while many continue to live in fear of getting their hours cut or being fired. Policymakers have sure demonstrated that being blind to all systemic problems in a country is a requirement to hold public office. However, something changed last year. A stock was discovered and millions have rallied around it among some other stocks. These meme stocks, as they would eventually were labeled, have become the best hope we have. They will work as a reset to rebalance a lot of the wealth that has been pooled in isolation for the 1%. Though nothing about this video was positive, I do take comfort that every meme stock I own is a ticket for generational wealth. This will be the greatest wealth redistribution we have ever seen in history, and I will continue to add until we rocket off this God-forsaken earth. And with this last ray of hope I have imposed onto you, we come to an end. I hope to have added value, information, education and understanding about how Wall Street got to prosper so much through the pandemic while the economy continues to decay. Now that you guys have such a profound understanding of how exactly it is that we got here, I must ask you one favor. Let me know in the comments below what you thought of the video. If you want to go a step above that, feel free to like the video so that it gets pushed to others to see. I will leave you guys be for now until we meet this afternoon after the markets close. I hope to have inspired a wrinkle here and there. I want to thank Amanda Fisher one last time for her incredible work, who I greatly borrowed and used. She serves as hope that there are still good journalists out there. And again, thank you all so much for making it to the end of this video. If you want to support the channel, I have left links in the description for my Patreon if you would like to pledge a monthly support of any amount you want. I also left a PayPal and Cash App link if you want to make a one-time donation. Have a great rest of your weekend and to the moon.